Let's move on to standard deduction. So, Brett, this one goes to you as well. Like I may be smart, but I'm no genius. Standard deduction pretty much to me means what you can deduct from your tax bill. So,
Yeah.
so explain what it means, like in more detail to the layman, and how the bill impacts standard deductions.
Yeah. So standard deduction, the best way to explain the standard deduction is just an amount of tax-free income that you get. So if you're single, married filing joint, married filing separate, head of household, there is a standard deduction, and you can just subtract that off of your income before you determine your taxable income. So for married filing joint in 2025, standard deduction is 15,007. Sorry, that's the single number, 15,750. For joint, it's 31,500. And like I said, that's just, hey, here's the amount of tax-free income basically. You don't pay any tax on this amount, and you can deduct that from your income before we figure your taxes. So that's the standard deduction. Now you get to take the standard deduction or itemized deductions. And so, a lot of people think sometimes that the itemized deductions have to do with, like, oh yeah, I itemize, I deduct my Schedule C business expenses or my rental expenses. And it's like, no, that's completely separate. Itemized deductions are personal expenses that you're allowed to deduct: your home mortgage interest, your property taxes, your charitable giving. Those are the things that you can deduct, but you only do the itemized deductions if they exceed the standard deduction. So what the bill did was, again, we've had these higher standard deductions from 2017 to 2018 with the passing of the Tax Cuts and Jobs Act. The standard deductions basically doubled. And what we get now is we get to keep those higher standard deductions. Now they've gone up since 2018 because they were pegged to inflation, and so they've continued to go up with inflation since 2018. But what they did here was not only did they permanently set these higher standard deductions, they even gave us a bump in 2025 over what the regular inflationary adjustment from the Tax Cuts and Jobs Act would have been. So we go from 15 to 15,750 for single, 22,500 to 23,625 for head of household, and instead of 30,000, we go to 31,500 for married filing joint. So again, we get to keep the higher one, but they gave us this bump in 2025, and it's still pegged for inflation, so it'll continue to go up every year from now forward. And huge benefit over Tax Cuts and Jobs Act, which is what we'll see from a lot of these. It was made permanent, as permanent as any tax law can be, right, until another administration changes it. But pending legislation, this is what we get from here till forever, because it does not expire like the Tax Cuts and Jobs Act did.
Yeah, so I was actually going to ask, but you answered the question already. Like, why aren't numbers like these like attached to inflation? But in some instances, they are, at least until the bill changes. So being aware of things like that, the fact idea that it's permanent, or and if it isn't attached to inflation, what are some other tax saving strategies that clients need to revisit, especially for those who itemize? That's also good to know that you itemize after you meet the standard. So the standard is more like your foundation, and then itemize after that. So what other tax strategies should clients be aware of?
Yeah. So if you think about this, very few married filing joint taxpayers have been itemizing in the last 8 years. And that's because your SALT, which we'll get into, your state and local taxes, that's your property taxes on your home and your state income tax, those have been capped at a pretty low number of $10,000. And so you take that, you add that to your home mortgage interest, and you add that to your charitable giving. And those are your top three kind of main itemized deductions. And you take a married filing joint return where the standard deduction, was around 29,000. It was 29,200 in 2024. And people just aren't getting over that number with their itemized deductions. And so some of the strategies we've had that have been going on for a few years now are bunching your charitable giving. So you might do multiple years of charitable giving into a donor advised fund in a single year to kind of get over that hump and get more benefit for those itemized deductions that you otherwise weren't getting any benefit for. So for example, we've got a lot of clients who potentially their itemized deductions are like 30,000 and the standard deduction was 29,200. Well, if 10,000 of that was charitable giving and you bunch that into 1 year, you could take the 29,200, which is only 800 lower than your itemized would have been. And then the next year, when you double up the giving, you're getting 40,000 of itemized. And so what it does is it just gives you that higher benefit kind of in every other year. And then you take the standard deduction every other year. Another piece of this is in this particular bill, they added in a, it's not above the line because it doesn't reduce your AGI, but there is a deduction for non-itemizers for charitable giving up to $2,000 for married filing joint or 1,000 for single. And what this could end up doing is I have clients who, okay, the standard deduction might be 31, it's going to be 31,500 in 2025. And when they add up their charitable giving and their mortgage interest and their property taxes and their state income tax, they're landing at 32,500. So typically you would say, okay, let's itemize because 32,500, it's not that much more than 31,500, but it is better, right? You get an extra $1,000. Well, we're going to have to look at that because if their charitable giving is five of that, well, they could get a $2,000 non-itemized charitable giving, which means that their standard would be 31.5 plus the two would be 33.5 instead of taking the itemized deductions of 32.5, which in the past, that's all we've had to think about. Are your itemized more than your standard? Well, now we have to think about, well, is it more than what you would have got with the standard plus the charitable? So there are going to be some people in that situation because if you think about the charitable giving, most Americans are kind of in that $1,000 to $5,000 range probably in their charitable giving. And so there's definitely going to be some situations where the itemized is higher, but not when you add in that extra non-itemizing charitable giving plus the standard. So I don't know if that one's super clear for anyone, but I was thinking about that one today. And, it's just, it's another piece we got to factor in. So, hey, every time Congress, president, whoever says, we're going to simplify taxes, all they do is they make it more complicated with more interactive pieces that you have to think about. There's a lot of interactive pieces with this bill that, you're going to have to look at how they interact with one another, just not just how they are on a standalone.
Yeah, here we are with that clarity word again. And Andrew, I feel like part of your job as a financial advisor is also to provide that clarity, specifically around charitable giving, right? You're dealing with these finances. A client comes to you and says, hey, I want to make sure I can give some to charity. You're looking at their portfolio, looking at their income, looking at their cash on hand and saying, okay, here's how we can move these around. So now that the same deduction is locked in, how do you approach charitable giving, kind of building off of what Brad just said there, in developing strategies to help clients achieve tax efficiency as well?
Mhm. So the biggest thing is, you look at it, the really, really big gifters, right? These are the folks who are maximizing their annual charitable gift. They're usually able to itemize. They may be
Hmm.
giving 30, 40, $50,000 a year. And then you have your folks like Brad mentioned, they give a couple $100, $1,000 here and there. In the past, they weren't able to itemize, so this little added standard deduction is a win for those folks. And then you also have yours who have the big income events. And now they're like, what do I do? So, for example, restricted stock vesting, private equity distributions, things like that, where all of a sudden someone who's making 120,000 a year is like, boom, I made 250 this year. Like, what are my strategies? Charitable giving can be a good piece to that. And the other components that I look at, like Brad mentioned, was the bunching of gifts using donor advised funds. So in those one-off years where they have really high unexpected income, oftentimes that might be a great way to shift a lot of assets that year to be able to itemize and take a benefit of the deduction. The other side is what gift or asset they're using too. Is it just cash? Are they giving cash gifts? Are they giving appreciated assets? Are they doing like kind gifts of homes, real estate, antique cars, things like that? So that's a big piece to it. But I definitely think charitable giving, looking at someone's tax return and seeing if they're able to itemize every year because they're giving a lot, especially over the last couple years because of the standard deduction being so high. I think there's a huge benefit and planning opportunity there where people, again, don't miss the opportunities out there. And it's a hard thing. You can't beat math. There's smart ways to give money. But at the end of the day, yeah, I'm not going to convince someone who hits a lottery of $500,000 and they're like, I want to avoid taxes. I'm gonna start giving away money now. It's like, okay, well, don't have the tax tail wag the dog. And most charitable givers aren't wired that way.